Broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. I'm here for our once every 3 weeks Investors Observer member-only workshop. Let's get started. All right, so here's our agenda for today. It's the same agenda we normally have. What's going on in Investors Observer, a market update, and then the rest is member-driven content, questions, site demonstrations, etc. I'm always happy to prepare slides ahead of time. If you send me a question, you can either reply to the invitation to the workshop or just send me a note that says workshop on it. Thank you to everybody who sent in questions today. We got a bunch of good ones we'll be going over a little bit later. All right, so what's new at Investors Observer? We've updated our watch list filter, or our watch list feature, excuse me. Let's see here. Find the website here. Sorry, I have a lot of tabs open. There we go. Yeah, so the watch list, you can get to it from like the stock dashboard. So we've made it easier to, view a stock, delete a stock from your watch list. You can rename the watch list. You can also, and this is a big thing a lot of people requested because a lot of people have big watch lists, hit that button to see your watch list in the screener. And then if you go straight to the screener page, you can also do like this to get your watch list to come up in the screener. So yeah, those are features that we added because people were asking for them. So we added them. So, we're always happy to get those sort of product improvement suggestions as much as anything else, and we try to be accommodative in terms of keeping good stuff like that going into the product. All right, let's move on. All right, so some charts. This is the chart we look at every time. It's 1 year daily candles of the S&P 500. I put this arrow here because this was our last workshop, because I remember discussing getting pretty far above the 200-day moving average, which is this bottom one here, and we sort of got pretty far above it there and pretty far above it there. And yeah, today ended up being kind of ugly. I don't know that ends up necessarily continuing on. I think there's a bunch of weird stuff going on today, some of which we'll talk about a little bit later. But yeah, I don't necessarily know that this is kind of this divergence, but this is a, distance above the 200-day moving average is a thing that people look at in terms of the market being sort of a little toppy or extended. So it's not super surprising to see kind of a halt there just from a technical perspective. All right, so this chart is the S&P 500 versus the S&P 500 equal weight. The equal weight's in blue here. So I bring this up mostly because this was a big thing last year, right? The S&P 500 outperformed the equal weight pretty much all year. There's been some outperformance of the equal weight here recently, but it sort of seems to have closed up. It kind of blew off a little bit and then closed up and maybe even coming back, which is interesting. But there are other places where, there are other places to find outperformance. For example, here's the S&P 500 versus the Russell 2000, so the Russell 2000, for those who don't know, it's basically the small cap index. There is something called the Russell 3000, and the Russell 3000 is essentially the 3,000 largest stocks, and the Russell 2000 is the bottom 2,000 from the Russell 3000. So it is the 2,000 stocks that are in the bottom 2/3 of the top 3,000, if that makes any sense. It's a little bit confusing, but that is how they do that. And so yeah, from here you can see small caps have been actually doing pretty well, even as the S&P 500 has been a lot slower to go. So that's a sign of sort of the rest of things catching up to those the big tech names that led the rally, kind of for most of the recovery of through 2020. But then here I wanted to point this out because so XLK is technology. This is what was leading the rally throughout the last year. This is only 6 months. But yeah, so technology has started to outperform again, where industrials have really started to slide. Industrials is the XLI, the industrial ETF in blue, have started to slide recently. I think there was a lot of sort of optimism around vaccines and things like that. But it seems like there's a little bit less of that, now as we're starting to realize, like, oh, well, this is going to take a while for things to sort of get back to whatever we start calling normal, when we start calling things normal again. And then Vince typed a question in here: is RUT the same as IWM? Yes, so RUT is sort of the index symbol, and IWM is an ETF that tracks the Russell 2000. All right, so what else is happening? We still very much, as I was just talking about, have a virus-driven economy. Cases are rising again. They may be slowing. The rise seems to be slowing a little bit as we get past the holiday travel season. Like it's been the whole time. There's some variation from state to state, but it does seem like things are sort of improving. Vaccine news obviously provides sort of a light at the end of the tunnel. But we do have some things where new strains do keep emerging. So far, those new strains seem to be covered by the vaccine. So certainly it's alarming that they seem to be more contagious and some things like that. But the vaccine should still generally provide a lot of help there. And then the other thing is, slower transmission rates lead to fewer mutations. Right? Mutations happen when things spread. If you can, stay home, wear a mask, stop things from spreading, we'll get fewer of those new strains emerging. On the economic stimulus front, they're definitely still going to try to do some things. There's some things they can get through. Republicans seem likely to try to block most of the Biden agenda at this point. After not hearing about it for 4 years, we're back to hearing about the national debt and things like that. So it's hard to know exactly what will pass. Issues related to taxes can be passed through reconciliation. So there's some things, tax credits and things like that could be passed there. We'll see what comes out there. And then, earnings season is underway. So far, things have, sort of generally been modestly better than expected. Some of the big banks had kind of blowouts. Market volatility ends up being good for banks. And then also all the, SPACs and the other things that have sort of been in the news is also, it's still equity underwriting. And then in addition to equity underwriting, you get to do M&A advisory on top of it. So that's, probably actually better for banks, for a bunch of companies to go public through a SPAC merger than to actually go through an IPO. So the big banks did real well. Tech earnings are this week. Microsoft kind of blew it out last night. I'm obviously here talking to you right now, so I have no idea what's happening with Facebook and a couple of the other big companies that were supposed to report this afternoon, but I would expect them to be okay. And then, we'll see where the, forward guidance is really where the rubber meets the road there in terms of, how fast people think we can get back to normal. That could provide some more push to move the market higher. All right, so our economic data is back. I'm hoping that after a lot of holiday noisiness, this will get back to being what I'll call regular noisy, sort of like it was here. And so, Chase consumer card spending is down 4.7% from where it was a year ago. That's down week over week, but still well above the March low. And then from the TSA, we've got, after bumps for Thanksgiving and Christmas, we got, a pretty good decline in terms of passengers per day through the TSA. That red line, there's a 7-day moving average. And that's kind of what I would have expected, to be honest. You get a surge in virus cases and everybody's done traveling for the holidays. People are going to pack it in and try to stay home. And then the daily rate of change in the 7-day average has gotten, just was super noisy through the holidays, but it's generally sort of drifting lower again, which is probably not surprising. Again, right, a weird thing about, maybe it's not weird, about the way stocks are organized is all your big transportation things, right? So airlines are in that industrial sector that we were talking about earlier that's, was performing better than technology and now seems to be coming back. So some of that is probably here, but also like railroads and things aren't doing well right now either, which may also be related. All right, so the thing I know everybody really wants to talk about today is GameStop. We had a great article by one of our analysts, Neil Farmer. It's on it's in the featured section of our news page right now. You can go read that and sort of get an idea of sort of the how and a little bit of the why, in terms of why GameStop is going crazy. The long and short of it is, that was an accidental pun that I just made. But yeah, the short story is that a bunch of people on Reddit got together and decided to buy it for whatever reason, and there are some mechanical things in the market that helped, once they started buying it, helped really accelerate the rally. And so it was closed at like somewhere between 340 and 350 today after being in the teens to start the year. So yeah, there's a lot of things to remember about this, right? Like GameStop hasn't discovered any revolutionary technology. They're still basically a company that sells video games from the mall, which in a world where people aren't going to the mall and also people aren't going to the store to buy video games because you can just download them. A lot of hedge funds, it turned out, had short positions here because it seemed like sort of a dying business. And so they got trapped when the stock started to go up. That's one of those mechanical things I was talking about in terms of pushing the stock up. But as far as, what should regular investors do about this as they're watching it? The things to remember are sort of, right, one is that lots of people are in markets for lots of different reasons, right? So GameStop is super interesting to watch. But I think of it in this terms, in terms of, I drive a car quite a bit, but I've never been in a car race. But driving or racing are both perfectly legitimate uses for cars. Somewhat venue dependent there, obviously. But driving and racing have different risks and rewards, right? Just because somebody wants to race their car and I don't, doesn't mean that's a bad use of a car, any more than me driving back and forth to work when I can drive back and forth to work is a bad use of a car. They're just, right, people with different goals and things that they're trying to accomplish with their automobiles. One's not right or wrong, they're just very different. So people who want to day trade GameStop or whatever, it's fine. There are some weird philosophical arguments you can make about, like, well, is this the purpose of, is this an efficient allocation of capital? That's not really what I'm here to talk about. It's an interesting, it's sort of an interesting question, but I'm not, probably not the best person to try to answer it. I'm not going to. But the other thing to remember is, like GameStop's gains aren't unless you were short, GameStop's gains aren't your losses, right? So other people have these giant paper gains. We'll get to that in a minute. But that doesn't affect your portfolio in any real way. So if what you're doing and your strategy is working for you, hey, that's great. And if what GameStop is doing is working for other people, that's fine. Now, all the factors that helped GameStop get so high so fast can absolutely contribute on the way down, right? The delta hedging and the short covering and things like that, right? Like those create some artificial buying pressure. And the delta hedging in particular can create some artificial selling pressure as the stock falls. It's an incredibly risky thing to try to get into at this point. It's been a lot of fun to watch. If you want to play around with it, that's great. But it's also very risky. And yeah, there's a lot of stories going around about the people who are now millionaires. But until you close a position and you have, right, until you've converted from GameStop shares or options to dollars, you don't actually have any money. You have a paper profit. And so, yeah, not very many people here have actually, there hasn't been much selling. So not very much actual money has been made here. And when people start trying to make money, right, that's when the party is over, as it were. All right, so there are a couple other questions here about this GameStop thing, so we'll go ahead and get to those. So Susie asked, how is the activity with GameStop, AMC, and BlackBerry affecting the market in general? I'm not really sure it is. There is, so, right, the way these hedge funds work, Melvin Capital is one that went bankrupt. There's some others that are having trouble. The way a long short fund works generally is they have some long positions and they have some short positions. When you have to close the short positions, sometimes you have to liquidate some of the long positions to cover your share. So there could be some downward pressure there. But the reason this strategy sort of works with GameStop and these other stocks is they have relatively small floats and pretty high short interest. Right. I mean, I don't necessarily know what these other hedge funds, what their long positions are, but it could have some nominal impact, but I don't think it has a ton of impact on the broader market. There's, could be some downward pressure. Obviously, if there's selling pressure, but it's, the buying pressure in an individual name versus a little bit of selling pressure spread across the market is not really something I would worry too much about. I think a bigger concern is sort of systemic in terms of what if people lose faith in the market because they get burned by GameStop. That's maybe an issue, but hopefully nobody is piling money that they really need to live on into GameStop. They have some sort of diversified portfolio and they're doing responsible things with that and then having fun with their GameStop investments. And then we got another question. Yeah, we're not going to send you an email about stocks like GameStop going up. Like I said, this is a whole thing that was conceived sort of on message boards on Reddit. It's not really what we do here. We have our system. It's the scoring system. We're looking at ways to add alerts and some other things like that for news and things like that. But as of now, we have no real interest in trying to identify things like this because of the unpredictability involved. Right, something goes up like that, it's going to come back down. It's just a question of when, and that's not really the sort of thing we want to get involved with. All right, so on to the questions. Muhammad asked, I want to know more about options trading. Can I do that with platforms like eToro, Robinhood, Webull, and Trading 212? So I know for a fact that some of these platforms allow option trading. I'm not particularly familiar with eToro or Trading 212 in particular. And yeah, they're the ones that allow options are probably fine if you want to buy a call or a put now and then. But if you're serious about options trading, and in particular if you want to do spreads and things like that, you should probably go with a broker that has a more robust set of tools. And the things I would look for there in terms of how do you define a more robust set of tools is multi-leg order tickets that allow spread trading. That's how all of our orders are entered. If you're going to do two things and try to get one price, you would prefer to put that on the same ticket and push it out there as opposed to trying to negotiate prices for two transactions. So that's one thing I would do. And then some educational materials about how to use the tools. I think they have worked to improve it, but a big criticism of Robinhood in particular is there's no phone support, and it's their websites and app are pretty intuitive, but if you can't figure it out, you're kind of on your own there. They don't have a lot of support materials. So that's another thing I would look at. And then, telephone support is also important, right? When the system goes down, you want to be able to call somebody and say, hey, can you, make this trade or bust this trade, or just, hey, why is this trade not working? And so the good thing about Robinhood for everybody else is Robinhood sort of broke the rest of the industry, right? No one charges commissions anymore. So you can get sort of all the benefit of Robinhood's coming, Robinhood came along and disrupted the industry, and forced everybody else to match them at no commissions. And so, the sort of more established players that have these more robust option trading tools also aren't charging commissions now. So yeah, if you're trading at, TD Ameritrade or Schwab or E-Trade or any of those kinds of places, you can still benefit from Robinhood's zero commissions because everybody had to match that. But you can do it with a more robust option trading platform. All right, so this question came from Michael. He had two questions, actually. The first was, when good news comes out on a stock and the stock jumps 10 or 15% in a second, how can I be the first to jump in when the good news comes out? And yeah, the answer to that is you can't. Right, there are machine reading algorithms and all kinds of other high-speed traders, and they're always going to beat you. Okay, there's no news feed you can subscribe to that's going to let you make trades before those traders. You're not going to be first. You're not going to be fifth. You can still make money from trading headlines, but you need to know which ones are likely to lead to sustained gains and which ones are going to cause some, what I would call a pop and drop, right? We've all seen the news headline that hits and the stock jumps up and then drops, or it drops and then comes back, because the headline didn't match the, rest of the story, kind of a thing. You're not going to do that, right? You could get you could get information slightly ahead, but you have to type things into the computer to make a trade, right? Like the robot doesn't have to do that. You're not going to beat that. So I mean, the real strategy there is don't even try. What you should do is just good investing practice, which is understand what's happening, understand why the stock is moving, and if it's likely to keep moving, right, then go ahead and don't worry about missing the first little bit, because you're in it for a longer haul. It goes back to my my race car analogy a little bit from earlier, right? Those high frequency algorithms and other really short-term traders, they're in the market and they're playing a game that's similar to the game you're playing, but it's not really the same game. And you need all these pieces for the market to work, but yeah, you can't. You're just not going to catch those jumps like that. And so really the best way to do it is to not try, right? Like play a game that you can play and succeed at. Right? It's not really a lot of fun to play a game where somebody else always wins. So yeah, the way to do it is not to get faster, because you can't. The way to do it is find a game that you can play and win at. And that is essentially just taking a longer view of the market. And so the second question was, I see ETFs like the ARK Technology ETF. When I buy this ETF, I'm buying a group of stocks. What if the group of stocks went up and the ETF had no movement, as investors may have no interest in it? Would that lose profit if I bought them individual, or ARK has to buy back shares to adjust the profit? So the way ETFs work is, right, they track some underlying index, and there are a series of financial institutions that create or destroy shares essentially based on supply and demand in the market to keep the price of the ETF pinned to the value of the underlying asset. And so essentially what happens is if all the stocks go up and no one's buying the ETF, well, I can buy a bunch of the ETF and turn it into the sponsor for shares, and that has the effect of destroying ETF shares. I get the shares of the underlying back. I make a profit from that, and now all of a sudden, because I bought a bunch of the because I bought a bunch of the ETF shares, the price has gone up and that goes away. So there's essentially an arbitrage opportunity for the sponsors of the ETF to sort of keep those things pretty pinned, and they don't come unpinned very often. It has happened, particularly with like levered ETFs, particularly like some volatility tracking ones. And I think there have been some severe, some big down days in the market where a handful of stocks get halted, and like your S&P 500 ETF no longer really tracks the S&P 500 because the ETF is still trading, but some of the stocks aren't trading. Stuff like that gets weird, but most of the time the ETF and the stocks are pretty much right together. So that's not really a thing to worry about too much. All right, so David said he's a new subscriber, and he asked, do we have plans to enable trading directly on TD from our site? That's the thing we've looked at. It requires a lot of work for every brokerage, though. It's not really currently on the schedule, but it's not totally out of the question. And then he also wanted to know how the auto trade works for our option portfolios. And the way that works is auto trading is a relationship between you and TD Ameritrade. You make allocations for what you want to put in your account in terms of one of our 3 portfolios, whether it's covered calls, diagonal spreads, or vertical spreads. TD checks with us to make sure you're a subscriber. And then we send the portfolio updates to TD the same way we send them to our subscribers. And TD handles all of the trading in your account. Investors Observer has no access or visibility into your account whatsoever. And so, yeah, that's basically how it works. It just saves you getting an email and having to enter orders. You can just do, you can set up auto trading once, and then the portfolios get traded in your account that way. Okay, that's a slide from last time, I think. Sorry about that. All right, so John said, is now the time to buy up more shares of tech stocks that have taken a big hit this week? And yeah, it really depends on which stocks we're talking about and what your goals are. And the sort of flow chart of how to figure this out looks like this. If the stock is down because tech stocks are down, you're probably okay, right? If it's just all the tech stocks are down this week, and there's nothing in particular going on with your stock, yeah, maybe you want to buy some more. If you're a long-term investor who has some extra cash to invest, again, right? Like, yeah, probably fine. The other side of those 2 questions, though, is if your stock had some negative development that caused it to go down, you should probably check and see what people are saying about it to see if you still like the stock, right? If earnings came out and your stock went down, reflexively buying the stock may not be the way to go there. Other sorts of things like that may not, that may be a chance where you don't want to buy the stock. So what you want to sort of figure out is, are good stocks going down with the market, or do you have a stock that's not a good stock anymore? And the other thing is, if you're a short-term investor and you're underwater and you just want to try to double up for some kind of bounce that you're expecting, there's no real reason to double down on stocks you already have exposure to. I would suggest maybe if that's the case, you should go try to find what's actually going up and buy that. Just because, yeah, doubling down on things that are moving against you is a way to turn a small loss into a bigger loss. But yeah, if you're a long-term buy and hold kind of investor and the stock is down because tech stocks are generally a little soft, yeah, that may not be a bad time to add to those positions, but you want to kind of, do some checks there, and not just reflexively be like, oh, stock's down, got to buy more. That's not necessarily the best plan. All right, so Randy asked, what is the best way to salvage a bull put spread when the stock price falls below both the long and the short put? There are 3 days left before expiration. There isn't really a good way to do this. This is really one of the things that makes vertical spreads risky, is you only get one shot and there's not really a way to buy yourself time. Some services recommend rolling the position. But what rolling a vertical spread means is you're just closing the current trade and then opening a new trade on the same stock that's either further out of the money, longer dated, or both. And so the important part of that is closing the current trade and then opening a new trade. And yeah, if you're underwater on the position, you're right to try to get out with any kind of credit when you roll it, you're going to have to widen the spread, or you're going to have to put cash in, at which point you're basically rolling to minimize a loss. Either way, you're closing a trade and opening a new trade, and you have more at risk once the new trade is open. And you're putting more at risk on a new trade on a stock that just did something you weren't expecting. To me, it's always seemed like a better strategy would be close that trade, figure out what you can learn from it, and find a new position on something that you maybe feel like you have a better handle on. Sort of similar to the last thing, right? Like, do you want to put more money into a stock that just went down for reasons you're not sure of? That's not a risk I'm typically comfortable to take. So yeah, you take a loss in this situation, but doubling down on a stock that just did something you weren't expecting seems like less of a good idea. All right, and then Ben wanted to know more about the Investors Keyhole service. So the Investors Keyhole service is part of our Elite package. You get 4 trades every day. They're mostly bull put spreads. Occasionally we'll slide a bear call spread in there. But yeah, they're mostly bull put spreads, and they are self-guided after entry. So we send you the entry point and the setup, and then you're on your own after that. Most expire worthless. It's above 90% have expired for a full profit over the lifetime of the service, which goes back like 15 years. And yeah, that's the full profit scenario. And so because they're self-guided and they mostly expire worthless, they're written further out of the money than the trades you'll find in like the vertical spread portfolio or in the screener. So they should require less attention, but they also sort of have lower rates of return. So let me pull one up here just so we can talk about how the actual service works. All right, so you get these by email. You can sign up to get some or all or none of them. But they all basically work like this. There's some news piece, right? So this is our upgrade and downgrade this morning. We're just piggybacking on analysts who upgraded the stock. And so we give you a little bit about what's going on with the stock. And then the trade is basically this piece. Okay, so it's the March 90-95 bull put spread for at least a 25-cent credit. So you're going to buy the March 90 put, sell the March 95 put, and you should do that for a credit of 25 cents or better. This is one of those cases where that multi-leg order ticket is pretty useful because you want to do both of these pieces and you want to get that 25-cent price, and you don't want to do just one of them for some other price. So it's really important to do that on that multi-leg order ticket. And then this trade returns 5.25%, and the stock has to fall almost 11% to cause a problem. So yeah, that's the Investors Keyhole service. And yeah, there's 4 of them a day, which means that there's usually about a handful more than 80 per month. I don't expect that very many people are doing 80 of these a month. It's really a thing about picking and choosing, whether it's here's a trade that I have time to make a trade, or here's a trade, let me investigate it and put this together. Either one of those is fine, but yeah, it's kind of a thing where we try to put out trades, and then how individual people use them is something we don't have a ton of visibility into. Just because there's so many of them and there isn't really a feedback loop there. All right, so that's the end of the prepared questions. Let's get into what you guys have been typing. Wow, okay, this box really filled up. Awesome. All right, what platform do we suggest for option trading beginners? I don't suggest a specific platform. All of the sort of, major discount brokers, your TD Ameritrades, E-Trades, Schwab's, I think that's all that's left at this point. There may be one I'm forgetting, but yeah, any of those guys are fine. Again, right, like if you just want to buy calls and puts, like Robinhood or something like that is also fine. And I know Robinhood has worked to improve their options offering. I haven't seen that. I haven't seen it recently. But yeah, you want to go somewhere where you can have support, right? Like if you're trying to enter a trade and you're not exactly sure how to use the website, it's nice to be able to pick up the phone and call, call people. People call here all the time and like, oh, I can't enter this trade on, whatever my brokerage is. I'm like, well, I'd be happy to help. I can give you all of the basics, but I don't have an account at every brokerage that exists. So I try to help as much as I can, but that's not a thing I can help you with. So, if you want help with somebody's website, or you think you might need help with somebody's website, you're going to need somebody who's going to answer the phone. Is kind of the only recommendation I would make there. All right, so David said, do bull put spreads have advantages over bear call spreads? They're essentially the same trade. One is bullish and one is bearish. And so given that over time stocks tend to go up, we mostly focus on bull put spreads. Again, we do throw a bear call spread in there occasionally, but we have had a lot of success with the bull put spreads. And yeah, it's largely just whether it's Adam Smith's invisible hand or whatever it is. Yeah, stocks tend to go up, and so that's sort of an easier way to not be wrong than trying to pick which stocks are going to go down. All right. Is your opinion is the move in PLTR similar to GameStop? PLTR, I think, is Palantir. Let me make sure that's right. It is. I don't know. Palantir is a more interesting case. I mean, the magnitude of the move in Palantir is not similar to GameStop. It's a big move, but it's not. Yeah, from 25 to 45 is roughly doubling, whereas from like 13 to 300 is a lot bigger move. So in that regard, it's not. I don't, without trying to look up on the fly here what the short interest and things like that is in Palantir, I don't know. Palantir also IPO'd, I think, last year. It's a tech company. It seems to be fundamentally different just from a company level than GameStop. It's also not wildly profitable, which I guess it does share that with GameStop. But yeah, I don't really know. I mean, just looking at them, I'd say they're not super similar. If you're asking me, is Palantir popular with people on Reddit? I don't really know. I look at Wall Street Bets occasionally, but there's so much going on there that it can be a little hard to decipher exactly what the main story is on any particular day. All right, so Becky asked, we have statistics on what percentage of our overall rating is successful. I'm not really sure how to answer that. The overall rating is, let's again go back to the website. And yeah, let's just pick a stock here. Okay, so yeah, the overall rating is really just a combination of our fundamental score and then the short-term and long-term technical scores. It's designed to be a good starting point. And again, all of our scores here are, with the exception of the sentiment score, percentile ranks. So AMC gets a rank that's better than 30% of stocks. The 99s are ranked better than 99% of stocks. I would expect those to do better than the 30s. But yeah, I mean, obviously, right, things don't get to be 99 and then stay 99 forever. They end up going back down. So really, the overall score is designed to be sort of a starting point, and then whether you're, a buy and hold investor who would, prefer to look at things like fundamentals and valuation, or a shorter term trader who wants to look at things like sentiment and the technical scores. That's really sort of how we imagine this works best for people, is using the overall score as sort of a starting point, and then figuring out figuring something out from there. We certainly don't have stats on how successful the overall score is, just because that's not really how it works. Let's see. So M said all 4 trades we send are for options trading and not normal stock trading. That's correct. The Investors Keyhole service are all stock trading, or all option trading, excuse me. And like I said, credit spreads. Yeah, so the screener updates once per market day. And yeah, so, if you catch it early in the day, the pricing should be pretty similar. Most of the time you can put in orders ahead of the market, and unless the stock does something crazy, you can get filled that way. Otherwise, you may have to adjust prices a little bit. And as you're doing those investments, what you want to look for is, can you get basically the same rate of return? And then you'll probably have a pretty similar trade. The same rate of return given the same expiration dates, right? You can move the strike prices around a little bit, but you probably want to keep the expiration dates roughly the same, or else you're looking at a different trade. Veda says, do we consider analyst-only updates from Investors Observer? I'm not sure exactly what you mean there, but if you want to put a little more detail into that, I'd be happy to take another pass at it. Yes, this question from Bill says, could we use the same terminology as TD? We say bull put, they say calendar put. I don't think that's right. A calendar spread typically has different expiration dates. So it's probably a vertical put spread. Now you may be able to enter a credit spread the way we do through the calendar put form. You just have to put the expiration date in twice. That's fine. But yeah, we're pretty comfortable with our terminology, just because different brokers call it different things. We're not gonna pick one and match. So yeah, but they're vertical credit spreads, but you could probably use the calendar spread form, but it's really a vertical credit spread. Right, so on the website, if you want to find the Investors Keyhole trades, go to Option Dashboard, and then right here under Investors Keyhole, there's a list of them. They're only presented in this text format currently. And then if you want to make sure you're getting them, you can go to My Account and Message Settings, and you can actually turn off each one individually. So, if you're super interested in unusual options activity, you can turn that one on. Or if you're not interested in it, you can turn it off. Whatever you want to do there is fine. But yes, you can turn each one off, or on or off, or turn them all on or off as you want. All right, so David asks, is the historical overall score available? It's not currently. It's a thing we've talked about. Not 100. Yeah, trying to integrate it into the product is a little bit interesting. but yeah, some things like that are some things we've talked about and would like to sort of add in the future, but we got to figure out exactly how to do it in a way that's useful and not confusing. All right, so do we only use Investor Observer analyst ratings to show stock ratings? So now let's just use Apple because it has all the scores. Yeah, so all of this is based on, our work, or a lot of it is. The analyst ranking in particular is a little bit different. The analyst ranking and this average analyst recommendation here, those are essentially, right, aggregated data from Wall Street. There's dozens of analysts on Wall Street that follow Apple. And so the average recommendation from all those analysts is a strong buy. And then the average price target is 132.07 with a high of 175 and a low of 78.75. So these are 12-year forecasts. And sometimes, yeah, this is a little bit weird because Apple hasn't really run up super recently. But yeah, analysts are probably not updating their forecast right before earnings. They'll probably do it after earnings. And so, yeah, it's a little bit weird to see the mean target price below the current price, and for the stock to have a strong buy. But that can happen, especially right before earnings, if the stock has moved a whole lot in a short period of time. It's not super surprising to see that. It does happen sometimes. All right, let's see here. All right, so we have a question about existing webinars. Right now, the best place to find them is they're just sort of scattered throughout the featured news category here. There's one about every 3 weeks. So there should be, yes, there's the last one on January 6th. We're working on a way to get these more accessible for people. I just want to see if they showed up in the related articles. It doesn't look like it. Yeah, we're working on a way to better organize these to make them more accessible, but we don't have one currently, but that's currently the best place to find them. And yeah, this session is being recorded and the recording will be posted on the website sometime tomorrow. All right, so there's a lot of question about sort of analysis tools. Yeah, so David, our normal spreads are less than $5 in terms of credit spreads. Every once in a while, for something like an Amazon or a Google, we'll do a $10, but I really try not to. Usually it's $5 or less. And yeah, with just the incredible, I've been doing this a long time. The amount of strike prices available now is pretty incredible. So we got some screener questions here. So let's go look at, well, let's start here actually. So we have a stock screener. Obviously we have some preset screens here that you can use. Some of these are free, some of these are available to, $10 is mostly beyond my risk margin as well. That's why 5 is usually the cap, unless it's, like I said, something like an Amazon or something where they only have $10 strikes and we really like the trade. But yeah, a lot of them are $1, $2, and $3. So yeah, if you're trying to stay under $10, shouldn't be too hard. And in the screener, everything is $5 or less. Yeah, so you can hit one of these if you want, or you can view your watch list in the screener, like we talked about. If you want to see solar stocks that have the highest volume, boom, there it is. But then you can also, if you just want to start from scratch, you can start here. And so there's 10,000 stocks in here, and you can put in whatever you want, right? Stocks between $5 and $25. There you go. Stocks with an overall score above 50, so that's the top half. You can do that. There's all these filters that are available here, plus more over here. And you can use as many or as few of these as you want. You can also sort by the columns if you just want to get market sentiment at the top, or sort it the other way, you can do like that. So that's the stock screener. And then the option trade screener, we had some questions earlier about credit spreads in particular. All right, so the option screener, you can screen for any of these 7 strategies. We'll go with the verticals because we had a lot of questions about it today. So there are 1,637 bullish vertical spreads today. Let's go through. Yeah, so we have these various columns here, right? Like previous close, credit, amount at risk, downside protection, what the individual options are, how far in the money it is. And this is a negative number for the credit spreads because they're actually out of the money. Probability of expiring worthless, whether or not the option expires before or after earnings, assigned and annualized return rates, days to expiration, overall score, key ratings, and then you can see more details here. You can also click through here and go to the stock page and see a little bit more about the option trades there. But let's go back here again because I want to talk about key ratings. So key ratings are a system that we developed to compare, right, to evaluate the relative riskiness of option trades. Okay, so the 5s are going to be the least risky, and the 2s are going to be the most, or yeah, sorry, the 1s. That's the lowest number, 1, not 2. The 1s are going to be the most risky. And so the things you'll notice here, if you try to compare the 1 or the 5s and the 1s, is the right 1s are typically longer trades. This doesn't expire until September. That's January 2022. And the key rating, or sorry, whereas the 5s are, these are next 2 weeks. The other thing you'll notice is the moneyness in the money and probability of expiring worthless tend to be lower for the same expiration date, if that makes sense, right? So if you found a 1 key trade that expired on February 19th, it would probably be less out of the money and have a lower probability of expiring worthless than this trade here. The key ranking does not take into account any sort of directional evaluation of the stock. That is what the overall score does. So another thing to keep in mind is the key ratings aren't comparable across strategies. Okay, so now vertical spreads and vertical spreads, those are probably pretty close, but like a 5-key vertical spread is probably not safer than a 4-key covered call. So it's entirely in strategy like that. So yeah, that's the option screener. Let's see here. All right, so we got another question about the investors' keyhole trades here. Fuel cell. All right, so this one, yes, the CEO of the company bought 11,000 shares on January 26th for almost $200,000. Yes, this is the same, right? The text here is pretty much the same. It's just kind of a fill in the blank as far as what they all say. And then, yeah, so this one we're going to buy the March 13 and sell the 15 puts again for a spread of 45 cents per share. That gives it a target return 29%, and the stock has to fall 37% to cause a problem. That probably goes over earnings based on how high that is, although I don't know, fuel cell's pretty juicy generally, so it's possible it's just because it's fuel cell. Yeah, we try to, yeah, so somebody said they actually got 50 cents on this one. And yeah, we try to price pretty conservatively. A lot of times you can get better. The idea is you can get a better, yeah. If we really push the price as high as we think it's possible to get, what ends up happening is the stock moves a little bit and then nobody can get the trade. And that's not really a product that anybody wants. Right? Like if I sent you an email and told you about a great option trade you could get 10 minutes ago, that's not a very useful product. So we try to price pretty conservatively, and then a lot of times people can get a better price when they actually make the trade. All right. See, I don't have any feature enhancements I'm particularly ready to talk about at the moment. We're always working on stuff. We have 8 or 9 things in the hopper at any given moment, but there's a whole development and testing process and things like that. So sometimes we just don't have a release on the calendar. But we are working on things. Do we have plans to show stocks IPO release date in the dashboard? So the problem with that is we don't have data about stocks that haven't IPO'd yet, but I will clue you into, on the news page, we have this IPO news section. So unfortunately, none of these tickers really go anywhere because the stock hasn't started trading yet. But there is a lot of news in here about IPOs, including, okay, so there's a pricing, so that'll probably start trading tomorrow. Things typically price the day before they start trading. So there is some IPO data in here. You can follow along with the stories as they go like that. But yeah, we don't have any real plans to build out an IPO offering yet, just because most of our product is about the data we can show you about stocks, and stocks that haven't started trading yet don't really have any data about them. So, all right, that's that. It's 5 o'clock. Thank you all for coming. Thank you for the great questions. This was a good one. Like I said, this is recorded. We'll put a recording up on the website tomorrow. We do these once every 3 weeks. The whole point is to sort of get the subscribers engaged and interested and help you with any problems you're having. But you don't have to wait for the workshop. You can hit this help button and send us an email. And we're pretty responsive. I try to answer questions. We have some other support people who help with that as well. Yeah. Anyway, thank you all for coming, and thank you for subscribing to Investors Observer. And I will talk to you again in 3 weeks, if not before.